Thanks, Matt. Bienvenue. Nous allons faire la présentation en anglais aujourd'hui, mais si vous voulez, parler avec moi après pour la présentation en français. So today I'm going to spend a little bit of time up front. I'll give you a very quick overview of the Mint and some of the businesses we're in so you can see our role in the precious metal space. Then talk a little bit about what we're seeing in the physical markets. That's what we know very well. We're some of the largest producers of gold and silver products in the world and use a massive quantity of those precious metals. And then I'll talk a little bit about some of the products that we have out there, the Sprott products that we're custodian of. I'll just touch on and then talk a little bit about how and why we launched an exchange-traded product to be in this business as well. So the Royal Canadian Mint, I mentioned the coins. So we do coins. We do all of Canada's domestic coins out of our Winnipeg facility, and we do coins for countries around the world. We're one of the largest commercial mints in the world. To give you just sort of snapshot in time, this year we're going to work for about 15 different countries, making 1.7 billion pieces of circulation coinage for other markets. That's right around the world that we do that business. We do more, but that's a sellout for us. So all the machines are running full out to produce coins. That's one of our mainstay businesses. And then in Ottawa, that's where we do the collector coins, a couple $100 billion worth of collector coins in a year, normally gold and silver precious metals, and then we do closer to a couple $1 billion worth of bullion products. So we're the number one producer of 1 ounce gold coins in the world and the number 2 producer of 1 ounce silver coins behind the U.S. Mint. I'll put a little bit of content in here. So we've got what we think is the most secure coin in the world. And there's the styrations, the radial lines on the coins that are very hard to copy, and we're always looking for new things. So we've got this laser-etched technology. So if you see the little maple leaf below the big maple leaf there, we now take a super high-resolution image of that, and you can authenticate it against a database that we have if you go into a local coin shop. They've got these little DNA readers that look like a hotel coffee machine. You go there, stick in the coin, takes a picture, digitizes it, sends it to us, and we verify whether or not the coin was produced by us. Very hard to copy. I don't think we could replicate the master dies. And the reason is, if you take a really close look, that little surface on the coin there, when you get up close, it's quite different for every single die. So we want to continue to stay ahead. It doesn't have to be absolutely impossible to make a fraudulent coin, but it has to be not economically feasible. So that's the goal, is to make it not economically feasible and to be better at it than all the other competing bullion coins. So if there's going to be fraud, it's not on our coins. This has done well for us, and this is a bit of an important story in the market. So we've continued to see very strong bullion sales over the last number of years. I've only put up since 2011 here. If you go back prior to 2008, a good year for us might be 100,000, 200,000 ounces of gold coins. Now we're doing in between 700,000 and 1 million ounces. So these markets, when they turn on, they turn on in a much bigger way, and the demand continues to be very strong. I know John had a puking day, as he put it yesterday, with the price of gold. Those are the days when our bullion desk picks up, because people in the bullion market, to see the price drop like that, and that's when they jump in and try to buy up physical products. So although I had a bad day with John, the people that are selling bullion coins had a very good day. In terms of silver, the story is even more pronounced. We're actually users, and if I just take our silver coins and I take the numbers that kind of come out of Thomson Reuters for global silver production, we're using on the order of 6-7% of the global supply of silver to make just the bullion coins. So we're a pretty big user of silver, as I point out, and that demand has continued to be high. And what really has limited the bullion market has been the supply rather than the demand. Because the demand has been unprecedented, what ends up happening is you just kind of hit up against your capacity limits. So there's only so many coins that you can produce. You can't buy enough capital equipment to really be able to supply the absolute highest demands in the market, because it would end up sitting idle for years at a time. So when there's high demand in the market, we all run out of the capacity to create blanks, and hence we can't sell into that market. We've added to our capacity in recent years, and we've continued to increase. I should say the bar on the far right, both in this chart and the former chart, is half a year. So things haven't gone down. It's just we're not done the year yet. So we're continuing to do well. We had 3 record years in a row. We may make a record again this year, depending on how the last quarter goes. So silver demand continues to be very high. On the supply side, which is something else that we know quite well, because we refine precious metals for mines and for scrap dealers, both in terms of gold and silver. And although mine supply has gone up a little bit, at least in Canada, and I think overall globally, the scrap supply has gone down. And it depends on which region you're in. Some countries are up a touch in terms of the metal that's being recycled back into the system. But generally, overall, the scrap has gone down more than the mines have gone up. So there's a little bit less supply in the market, which is a positive factor if you're looking at it from a micro perspective. And then the other market that we follow is exchange-traded products, and particularly true for gold. Exchange-traded products before the beginning of this year were largely net suppliers to the market. They were, since the end of 2012, the beginning of 2013, gold was coming out of these funds and it was supplying the market. So that gold was readily available and significantly contributed to the amount of supply. That's changed since the beginning of the year. So these funds are now net buyers of product. They've gone from one side of the demand supply to the other side and are affecting it. So also a positive element. I won't talk a lot on the gold versus gold equities versus general equities. I think John and Eric will probably have more to say on the merits of gold as an investment. We kind of like it. Gold is a portfolio investment where it's very low correlation to most other assets, and particularly equities, and as a result, it's got a place in a portfolio. But I guess the one thing that I'll talk about here is just this chart. It's a 20-year look at precious metals, and it's the same story if I run a 15-year, a 10-year, or 5-year. But any long-term chart, what you see is this. The blue line is gold price. The black line is the TSX, and the orange line is the sub-index of the TSX. The sub-index of the gold miners, on whole, have almost always underperformed gold price, other than short periods like the beginning of this year where things go up. But if you hold for a long time, you're going to underperform the gold price if you're holding gold equities as a passive strategy. So that's just to say that if you're going to do it, you need a better way than a passive strategy in holding gold miners. You can't bet the universe and expect to outperform gold price. So you either have to find that more intelligent option, which Sprot's got some of, and otherwise you may just want to look at the physical metal that's got certainly less risks in certain class of risks and less volatility. So if you do decide you're going to go the physical route, I can vouch for all the vault space taken up by the Sprott products. So we're the custodians on the physical gold trust, the silver, for both gold, silver, and for platinum, palladium. So that's all there, physically held for them. We also hold for some of the mutual fund products. In 2011, I launched for the Mint, the Mint's gold and silver exchange-traded receipts, so those are also options. Hard for me to objectively say which one is better. The only thing I guess I'll say is that if you don't mind being held in U.S. dollars, Sprot's a lot bigger. If you want to hold something in a Canadian dollar account, then the Mint's product is priced in Canadian. We do have U.S. dollars as well, but most of the trading is Canadian. But let me explain what it is and why we did it. And maybe first I'll start with why. So I talked a bit about the fact that the Mint is very large in the precious metal space, both on the refining side and on the production of bullion coins. And the biggest cost in a bullion coin, other than the gold, traditionally has been the financing of that gold or silver as it flows through our facility, because we have to finance that work in progress, finished goods inventory. Well, the reason we designed the exchange-traded receipt program was to finance that inventory. So investors effectively own what's sitting in our finished goods vault and what's sitting in our work in progress. And they effectively give us the rights to use that metal in our facility, so long as we hold it all there, and we deliver it out if the investor requires it. So that's That's why an agent that is effectively a Crown corporation, agent of the Government of Canada, entered into something that's more akin to the asset management business. It wasn't really that we wanted to be asset managers. We just wanted a cheaper way to finance our inventory. We're effectively an arm of marketing gold and silver for Canadian mines because we're using so much metal and we're shipping it overseas. Our main markets aren't Canada. They are the United States, Europe, and to a lesser extent Asia. So that's the thought behind the product. So what is it? An exchange traded receipt's pretty simple. It's just physical metal that's owned by the investor and stored at the Royal Canadian Mint. It's a specific amount of metal underlying each receipt. It's a little more than 1/100th of an ounce of gold and a little more than 0.6 ounces of silver. And the investor directly owns the metal. This benefits both us and certainly Sprott, but the Mint is an agent of the Government of Canada. It's the tradition of Crown corporations in this position that any obligation that we can't meet falls to the Government of Canada. So uniquely, you have a Crown sovereign entity that's backing up precious metals products, so that's a benefit. And of course, we've worked for 80 different federal governments over the years, or foreign governments over the years, in a number of different countries, and we've certainly been custodians of some of their precious metals and certainly some of the currency. So we're a well-trusted organization. Structure I talked about, it's really just physical metal held. There aren't a lot of parties involved, so the investor actually directly owns metal. So the only relationship they have is with the Royal Canadian Mint. That's beneficial. If you look at some of the other structures that are out there that have multiple different parties involved, each party has a little bit of cost and a little bit of risk, and we think this is just a nice, clean way to directly own metal if that's your investor's objective. In terms of efficiency, we look at it relative to a physical investment in precious metals. We like to do that as well because we produce those, so happy for people to have physical at home, but for people who want it in a brokerage account for it to be liquid and readily available for use and if they ever need to sell it or to borrow against it, then this is a very good option. As a result of this savings that we get in terms of putting metal into a facility that's already up there and operating, we've got all the vaults and the security, we can offer it at a pretty low cost, so 0.35% per annum for gold and 0.45 for silver. Silver, by the way, costs a little bit more. It takes up a heck of a lot more room in a vault per dollar basis, and it takes a lot longer to count. We audit our precious metals. We count in the presence of the Auditor General of Canada, who is our auditor. Have been doing it 4 times a year, and I think we're going to move to 2 or 3 times a year in the future. It's been a lot of counting, and the numbers always come out pretty darn close, so we're going to reduce that a touch. And then in terms of convenience, we've got some really good redemption options as a manufacturer of precious metals, and because we're holding gold that's our work in progress and finished goods inventory, we can give the investor, if they so choose, the ability to take the physical metal out. And you can take it out in 1-ounce coin form, kilogram bar for gold, or 100-ounce bar for silver, and then the big trade bars that you see in the movies that are the London trade bars. So any kind of metal premium price that you would normally pay in the physical market, you don't pay it to own the instrument, but you pay it if you ever decided to take it out. Because there's some, as I talked about, there's a little bit of labor involved in precious metals, so kind of the smaller denomination your product, the higher a premium it sells on the aftermarket. So we've got that, and because we're not just using the trade bar, you can take out a smaller quantity of precious metals. The redemption options, though, really are set up to support liquidity in the product, so it allows, if the price of the security ever trades below the metal value, people will start to move in and purchase the units and either wait for that price to correct in the market, or they can actually withdraw the physical metal and sell that and make a little arbitrage there. So it supports trading price. Product does as it's intended to do, so it attracts the gold price. The only thing in the instrument is gold. Differs in that respect from a fund. So because there's no entity there's no expenses that are sitting in the program other than the management fee I mentioned, and there's no cash that's held. We actually pay ourselves in gold, which we then sell off as coins and things. So we feel exactly the pain on the down days with the investor, and we we all are happy when it goes up, so we're all in line. And same's true about silver, which tends to track very closely the net asset value. Thank you very much.